Good afternoon, friends, and welcome. I'll be sharing live trades and results with you. We'll be evaluating how well these trades work out. We'll be benchmarking this against the S&P 500. I'm expecting to be outperforming it every month. Along the way, I'll also be sharing some lessons I've learned about investments, trading, and building wealth. And of course, the mandatory disclaimer. This is for educational and entertainment purposes only. It should not be interpreted as advice. And with that, let's get into it. Today I want to talk about investing and how to compare one investment to another and how to measure rates of return. So for example, I'm going to start out with something incredibly simple. And of course, since I'm using numbers, we've got to work with Excel. So here's two investments. I've got $100,000. These are fictitious numbers, and I have $50,000. And when I invest $100,000, I end up with let's say $5,000. And in my other investment, maybe I end up with $3,000. And I know a lot of people will look at those and say, for some folks will look at this and say, hey, I made $5,000 versus $3,000. Clearly $5,000 is more than $3,000. It's a better investment. But what they're not taking into effect is how much they're actually starting with in the investment and what it's actually, how it's performing. I think the only way you can do that is with rates of return. So, just to show you which one is actually better, we'll just do a simple calculation for rate of return on an investment. In this case, we can see the first one returned 5%, but the second returned 6%. It's actually it's a better investment. So the one thing I just want to start out with is something incredibly simple. You just can't look at sheer dollar amounts or only dollar amounts and say one investment's better than another. You really need to look at the returns and how those compare to each other. And it's important that you measure them the same way so you can compare them so you know which ones are more important. The other thing I might add in here too is risk factors in here too. But let's say all things being equal, these are the performance, and clearly the second investment is better. If I could funnel more money into that investment in the long run, I'd be much better off. Okay, so now that I've determined sort of how to compare these investments, I want to look at another scenario of actually how to get those measured returns. Again, I'm just starting with the hypothetical $100,000. Each row represents a year. So I captured some hypothetical returns. I started with the S&P, but I think for the purpose of this, we'll just show a fictitious set of returns, its gains and losses. And here's how I built this out. So start out with $100,000, put in a rate of return, like it might be reported from my investment firm or my stock reporting. But that's what that number represents. This represents the gains and losses. So 39% of $100,000, $39,000. If I add that back into my original balance, that means it's $139,000 at the end of that year, which starts out the next year. So it's just sort of working through 10 years of investment at varying rates of return. And again, these are just ones that I picked. But a lot of companies will give you a measurement called average rate of return. And it's simply a 1-year average, a 3-year average. And this is most important when you're reinvesting your returns like this model is doing. So if I made $39,000, I'm reinvesting that each year. The way that this is measured matters significantly. And it'll matter, I'll show you where it matters, even how those variances even show up more. So average rates of return will show you, if you took the average of all these returns, it's 16.4%. But I think most people, and certainly I'm doing this in my life, is reinvesting at this point in my life, reinvesting those returns. So there's a different rate that sort of matters, and it's called a compounding rate of return. I'm going to show you a formula for it, but it's basically taking the same sets of returns, but using this formula, it's actually coming closer to what the estimated rate of return there is. Let me just fix up this formula a little bit for us. This is the beauty of doing it live. this returns get a little bit closer to how it's actually performing. So if I put money in an investment and I let it compound each year, it's going to be closer to 12. This is the number that I use. This compounding rate of return is the number I use to compare my investments to everything else. And if you get a consistent rate of 5%, it doesn't. They're going to be the same number. If this was 5% every year, in fact, I'll even show you that. If it's 5% every year, then both numbers are going to be the same. It comes into play when there's variances in the returns. Like, for example, my first year I've got 10%. They're starting to shift a little bit now. And it matters a lot if there's any losses. So typical scenario, I just started my investments and the first year I'm doing great, 10%. Second year I lose 10%. Some people also think, well, that's fine. I'm up 10%, I'm down 10%. No problem. I'm sort of at my starting point. But if you look, I'm actually not at my starting point because 10% of 110,000 is a little more than 10% of 100,000. So, this is another lesson that I learned is being up a certain percentage and down a certain percentages doesn't bring you back to even. It actually makes it worse than even. If I even accentuate these gains and losses by just a little bit, let's say they're 15%, now you can see that I have less than I started with. So it's critically important. And you can see how these returns are starting to diverge. So, just in the simple scenario where I had a really good year, I had an equally bad year, and then the rest were all consistent, I have a really different rate of return. So, some things that are going to matter is how much volatility there are in these returns, how many negatives, years of return, and when they occur, because I'll show you another scenario that makes this even worse. So let's say that same thing happens a little bit later. I have a really good year, and then I have another bad year. We're talking about, in this case, a relatively small amount, 0.5% of difference, but this really starts to matter a lot, especially when these variances start to swing a little bit wider. These upticks in the market that we've seen in the last couple of years, we've had some really good years, and then 2008, 2018, market drops of 25, 30%. Let's go with the 30% here. And you can see that, now it's getting more than, 0.5%. Now it's really mattering. More good returns next couple years, sometimes not as good, maybe 2 years of good returns. And then we've got something like currently where markets are down, let's say 40%. And you want to look at these investments and go, how does this particular set of returns compare against another? Well, now it looks a lot different. And I think that matters a lot. So that's why I think using a compounded rate of return is more realistic, because what this is showing at 10 years, I ended up with $105,000, even though at times I was up 175,000. Those are great returns. But at the end of the day, I'm closer to a 1% rate of return than something like an average of 3%. So I'm going to add in a few more columns here. And what this scenario is doing, it's basically mimicking this, but it's using the rate of return and average rate of return to try and show you what your expectations would be if you had an investment of 3.5%. And you think, I'm going to get 3.5% every year, it's average rate of return, I'm going to end up with $136,000. But because of the volatility and when those events happen, you don't. You're going to significantly underperform what you think you are, and that's why I think compounding rate of return is much better than average. I'm adding in a few more columns because I'm doing something similar with the actual calculated compound rate of return. And what I want to show you is it's not an exact amount, but if you compare 109 to 105, it's much closer than 136 compared to 105. So it's not going to be precise, but I think it's going to be better, and it's going to be a little bit more of a conservative measurement. And again, I'm just sort of reinforcing why the compounding rate of the return is what I typically calculate and what you'll see in my performance benchmarks as we're watching our live trades happen. I'm going to go ahead and add a little chart in here so that you can also take a look at, it's basically comparing Let me see if I can show you the data sets for these, comparing this set of returns to the average rate of return, and why your performance might look different than your expectations when you start talking to working with an investment advisor or whatever. Again, I think just going to add a few variations in here. With a couple of negative returns and volatility, you're going to start seeing that I'm starting to spend a lot more time, below what I thought I was going to see than above. And certainly where I'm ending up is not as good as I thought. Just adding another, just even a small rate of return. Sorry, that was 50. That's not what I meant. Just a small difference, and it's really starting to make a difference in how things are shaping up in terms of with respect to my returns. The more volatile this gets, those worse expectations are, and the more that I will start finding time where I'm spending, my actual returns are below just a simple 2% average rate of return that I'm never going to see. So, again, just trying to illustrate this graphically, why your returns your expected returns on an average rate of return aren't going to be as solid as a compounded rate of return, and you're certainly going to be a little more disappointed around what those returns actually end up being. I'm going to show you one last scenario about returns, and that is talking a little bit about, I mentioned that this is critically important when you're reinvesting your returns. Not reinvesting your returns can be a way to dampen volatility. And I've got a similar scenario where I've got same set of returns, but in this first scenario, you can see I'm reinvesting the returns every year in this case. In another case, I'm not reinvesting. I'm just going to do the same $100,000 every year, and I'm going to let those returns accumulate. You can see some interesting things happen. One thing you're going to see is it's not going to perform quite as good by not reinvesting returns if generally you're having positive returns. But what it does do in a very significant way is change what happens when I start hitting negative rates of return. So it won't feel the impact of a negative year as much. And this one I'm sort of mixed on. And I think there may be a way for people to think about how much am I going to let accumulate before I possibly put back into those investment principles, and maybe when a good time might be to do that. And we're going to talk about timing the market and averaging in the market, and some other strategies about how to actually get money into the market without taking on a lot of risk. But that's what I wanted to cover today. I appreciate your time and attention, and thank you. That's it for today. How do you think we're doing? Please comment below and let me know how this compares to other investments you've seen. What is the best performance you've experienced? And remember two things. This is for entertainment and educational purposes only and should not be taken or interpreted as advice. And don't forget to like, subscribe, and hit the bell notification. Until next time.